So here we go again. Numbers 3 and 4 of our adjusting entries. So this is my third video on adjusting entries, the basics. We'll get into some more detailed ones later when my hair looks better and I feel like I could describe more things and I get a better easel. I'm trying to do a makeshift. So let's talk about accruals. Now the accrual basis of accounting is what we're trying to do. So that's one word that means accrual. But accrued entries are the two that we haven't talked about before. They're when the action comes before the cash. And I like that little AC. I invented that. So don't tell anybody that, but I invented that. AC, accrual, action comes before the cash. Now what does that mean? Action. That means I have done the work, but haven't been paid for it, which is okay because I still take the revenue because I've done the work, and that's the revenue recognition concept. And I have like incurred an expense, like used some utilities, but not paid the energy company yet, which is quite all right because that's how the billing cycle works. So in those two situations, my revenue is the work I have done, and my expense is the utilities I've used, but the cash isn't there at the same time. So let's do those entries so that we can put them on our books. A lot of times we don't think about these entries until the end of the month when the accountant really has to true up the system to make it right. So let me turn this so that you can see my easel. So in accruals for the revenue, I'm going to talk about the first one that we talked about in the earlier chapters, accounts receivable. In this case, we did the work, but we never got any money. So whatever you did, if you're the plumber, you went ahead and you came to my house, you fixed my house or fixed your house, and then you billed your customer and they will pay you. So an accounts receivable is just as good as cash from the standpoint that it is an asset. It's an asset with a promise to pay. Remember, it's a resource and it's a future benefit of cash that you'll get. But we get to take, the plumber gets to take the service revenue because he already fixed everything in our house and he did everything. So the revenue is taken at the time that the action is performed and it is earned. Does that make sense? We've had that before, so I think that one's okay. Then that is the adjusting entry. It's not in red like I do in class, but it's the adjusting entry. Even though that could happen like on the day of the service. The plumber could go home, take out a bit, write out a bill on the 15th of the month and send it out and take that adjusting entry then. Another one that comes about usually at the end of the month is one that's a little bit more complicated, but we did in class. Interest. So we've loaned some money to somebody and we have a receivable, a note receivable. With that note receivable comes some interest. That is the revenue we're going to get from lending money out to somebody. This one's a little more difficult. You have to think about the time period that the money has been lent out and used by that person. So an interest receivable, you need to do that I equals PRT, but figure out what period of time the note has covered. This particular one, we lent $1,000 for a year in August. So August 31st, which is really the same thing as saying September the 1st in terms of calculating this amount. This is the December 31st closing entry for the month, for the year. We need to make sure that we cover the interest for that period of time. Now, if it's a year-long note to somebody and the interest rate is 6%, eventually the person's going to pay us $1,000 times a year times the 6%. But for the months that since we lent the money, August 31st, which if you count them, September, October, November, December, 4 months have gone by and we have actually earned that revenue because the person has borrowed our money and he has an expense, but we have a revenue. So we need to record that to make our revenue be correct for this year. So on I equals PRT, $1,000 times 0.06, which is 6%, times 4/12 would give us $20 if I did it correctly. I don't have a calculator at home. Can you believe that? $20. And that would put the $20 in this year's income, this year's revenue. And that's when we want it in here. Do you know how to do those? So what would happen the following year? The following year, when he paid us back, we would get some more revenue for those months, but we wouldn't get the revenue would not be double counted because it would have gone in this year's as a receivable. And we can talk about that later. Now let's look at accrued expenses. So accrued expenses are the opposite of accrued revenues. So somewhere else, there's somebody with a utility expense, and the utility company has got a revenue. So we've got utility expense, we got the bill in, and the action has happened. We use the utilities, but we haven't paid the bill. Now we've had this happen. So utility expense for this month is recorded in this month's expense, but the payable will be paid next month. So that one's pretty clear. When we pay it off, we know what happens. Salary expense was a little harder to learn. So let's try to focus on that if I can get this easel to work. Let me just pull this up. So salaries was a little bit more confusing for many people. So if there's a 5-day work week and payday is on Fridays, but the end of the month or the end of the accounting cycle, which in this case is 12/31, December 31st, is a Thursday, then December's or last year's, if this is 2010, needs to have these 4 days of work as expense in that period. Think about that. So these 4 days, when did we incur the expense? When did our employees work? They worked in December, and they worked those 4 days in addition to some other ones, but for this week, they worked those 4 days. So it wouldn't be right when we wrote the paychecks out to take that as an expense because this is January. So we don't want to take any January expense that doesn't belong to January. So the way we would adjust that is figure out what 4 days of these cost and go ahead and accrue that into salaries expense and credit it to salaries payable, which is a liability. And I've sort of given you an example for you to figure out. So let's just say that the expense, the payroll is $100 a day. If it's $100 a day, how much should go into the salary expense right here as a debit? How much belongs to December's or to 2010's? And then how much would January absorbed? So if it's $100 a day, this entry should be $400. So $400 in expense and $400 in payable would put the correct amount of money in salaries in 2010. Hopefully that makes sense. And we'll try to review these again in class, but try doing some of the problems that I've given you for homework and see if that makes sense. And there are other accruals that you can have. You could have an interest expense and an interest payable the same way we had interest revenue a few minutes ago. All those are accrued expenses because the action came before the cash. And we will talk some more about this in another problem that I will do.